Hey, how's it going, everybody? It's Mr. White here with your Unit 4 test review. Sorry, my voice is still not great. Still getting over that little sickness that my lovely son gave me. So just listen carefully, and if you can't understand what I'm saying, just look at the screen, because everything I'm saying is going to be on the screen. So follow along, get out that brown test review paper, and write down these answers as we go over them so that you can be ready for the Unit 4 test. Okay, first thing I want you to do is know how to draw the money market graph. Hopefully you remember that on our y-axis we've got the nominal interest rate, and on the x-axis we've got the quantity of money. That perfectly inelastic curve is the money supply. Remember, the reason why it's perfectly inelastic is because it doesn't depend on the interest rate. The only thing that determines the supply of money is the Federal Reserve. Now, the downward sloping curve is our money demand line, right? So that shows the demand for money in our economy. And wherever those two curves meet, the intersection point is going to be our equilibrium, and that determines our nominal interest rate. So the main thing you need to know here is some of the factors that influence the demand for money. For one thing, the available banking technology that people have will determine their demand for money. So in a society where we have lots of ATMs, lots of checking cards and debit cards and other kinds of mobile payment, like for example, Apple Pay, those kind of societies have a much lower demand for money. What we're talking about here is physical cash. Obviously, if you have all these other ways to pay for things, you really don't need physical cash. Now, the price level, meaning the consumer price index or the CPI, is also an important factor. When the CPI is really high, people have more demand for money because it takes more money to buy things. When the CPI is low, there's less demand for money because it doesn't take as much money to buy things. Real GDP also influences this. When real GDP rises, generally that also causes prices to rise. And when prices start to rise, that usually causes more demand for money. So more GDP, more economic activity, more demand for money. And the last thing here is banking regulations and interest rates. Generally, if there are more banking regulations or if the interest rate is really high, there's less demand for money. Yeah. Cheyenne Will, if you're in the building, which you're probably not at this point, please report to the rotunda. Okay. Anyways, sorry about that disturbance right there, guys. But like I said, if interest rates are high, money demand is going to be low. But if interest rates are low, money demand will be pretty high. Now, the next thing we need to be able to do, or the next thing I should say you need to be able to do, is show me how an increase in the money supply will change the equilibrium point. So if the money demand were to increase, like you see right here, and the money supply stays constant, that means that our nominal interest rate is going to increase. And the opposite is true if we have a decrease of our money demand with a constant money supply. I don't have the animation for it, but if you can just imagine if that money demand curve shifted to the left, we would see that the equilibrium point would move down, which means the nominal interest rate will drop. So an increase of money demand will cause an increase of interest rates. A decrease of money demand would cause a decrease of interest rates. Okay, so the loanable funds model is next. You need to be able to draw that. Remember that on the y-axis, this time we have the real interest rate, and on the x-axis we have the quantity of loans. So this upward sloping curve is the supply of loanable funds, and the downward sloping curve is the demand for loanable funds. Basically, this just looks like a normal supply and demand graph. The point where they meet, that equilibrium, that tells us the real interest rate and how much money is going to be loaned out in the economy. All right, so the supply of loanable funds will change for two reasons. Number one, if we have a change to saving habits in the U.S., meaning that if people save more money, the supply of loanable funds will increase, because we know that in a free market economy, the supply of loans is directly proportional to the supply of savings. So more savings, we would have more supply of loanable funds. However, if people spend more and save less, then we will have less supply of loanable funds, and the supply of loanable funds would move to the left. Now, if there's a change to foreign investment in the U.S., we call that capital inflows, meaning like if more foreigners put their money in U.S. banks, then we'll see the supply of loanable funds increase. But if foreigners start taking their money out of U.S. banks, then we would see the supply of loanable funds decrease. Now, the demand for loanable funds can also move around. Once again, there's only two determinants. The first determinant would be a change to government spending, aka fiscal policy. So if the government were doing an expansionary fiscal policy, meaning that they're going to spend more, generally they have to borrow more to make that happen. And so in that case, the demand for loanable funds is going to shift to the right. It's going to cause a rise of the real interest rate. However, if the government were to pursue a contractionary policy where they're going to spend less money, then the demand for loans is going to fall, and also the real interest rate is going to fall. The other thing that could change our demand for loans would be a change to perceived business opportunities. So if businesses see a really great opportunity on the horizon, they may be willing to borrow more money now to take advantage of that opportunity. A great example happened back in the 1990s when computers started becoming more powerful and also more available to the general public. As more and more businesses saw that computers can make their business more efficient, they started demanding more loans to be able to upgrade their technology and buy more computers. So whenever businesses saw an opportunity to be more efficient with computers, they increased their demand for loans. So the demand for loanable funds increased, but the interest rate will also increase in that circumstance. Okay. Now, one other thing about the demand for loanable funds that you need to be aware of is how a shift of the demand or the supply of loanable funds will change the real interest rate. Okay, like I said, equilibrium is that point where the two lines meet. So if we saw our supply of loanable funds increase as I just did, you'll also see that the equilibrium is going to change. When that equilibrium changes, as we just saw in this example, if the supply of loanable funds were to increase, the real interest rate would decline, but the quantity of loans that are issued would increase. That would be a really great circumstance for borrowers. However, if the supply of loanable funds were to decrease, we would see that the real interest rate would rise and the quantity of loans would also decrease. So make sure that you know how shifting around the supply or demand of loans would cause a change to the real interest rate and the quantity of money that's being loaned out. All right, the deposit expansion multiplier. Remember, this is that really simple formula. 1 divided by RRR, or 1 divided by the reserve requirement ratio. The number that you get from that will tell you what is the banking expansion multiplier, or the banking multiplier. So, for example, if a bank were receiving $500 in demand deposits, which means checking account deposits, and the reserve requirement ratio is 5%, first of all, how much money does the bank need to hold in reserve? Well, what you need to do is figure out 5% of 500. So you do 500 times 0.05, which is 25. So that means the bank must keep $25 in reserves. Now that we know that, how much money could be generated by this $500 deposit? Remember, we said that when you put money in the bank, if we assume that the bank is going to loan out everything they can, and then that money gets deposited in another bank, that bank's going to loan out as much as they can, and then that money's going to get deposited in another bank, and then that bank is going to loan out as much as they can, and on and on and on. Okay, so what we'll do is we'll figure out the deposit expansion multiplier and then multiply that number times 500. So in this situation, we'd say 1 divided by 0.05. The reason why is because our reserve requirement is 5%. So you got to keep in mind that if the reserve requirement is 5%, that's 0.05, not 0.5. If you put 0.5, you're going to get the totally wrong answer. Okay, so 1 divided by 0.05, as you can see here, is 20. So that means that our deposit expansion multiplier is 20. So what we need to do is we need to multiply 20 times 500, which gives us 10,000. So that means that the banking system can generate a maximum of $10,000 from this initial $500 deposit if the reserve requirement is only 5%. This is why having a low reserve requirement is going to cause a greater multiplier and therefore will cause a greater increase to our aggregate demand. This plays into monetary policy, which is what we're going to talk about in just a moment. First, we're going to talk about fiat money versus commodity money. Now, fiat money does not mean money that's for buying small Italian cars. It means money that only has value because the government says so. The term fiat means by order or decree of the government. So fiat money is money that functions mostly as a medium of exchange because the government says so. So paper money is a perfect example of fiat money. It's the kind of money that most countries use in the world today. Now, in the past, a lot of countries used what was called commodity money, money that has intrinsic value. Intrinsic value means that the thing is valuable because of what it is, not because the government says so. So, for example, gold is a great example of commodity money that's been used throughout the years. Gold would be valuable whether the government said it's valuable or not. And for that reason, gold functions primarily as a store of value. So in other words, if your currency, if your fiat money had a really high inflation rate, you could buy gold to protect the value of your money so that you don't lose purchasing power. So make sure you know the difference between fiat money, which is just paper money that's issued by the government, and commodity money, which is money that has intrinsic value because of what it is. It has uses other than serving as a medium of exchange. All right, now monetarism. Monetarism was invented by this handsome dude, Milton Friedman. Monetarism is the idea that the money supply should grow in proportion to real GDP. So if the money supply grows steadily, then real GDP will also grow steadily, okay? Friedman thought a good rate was about 2 to 4% per year. So keep in mind that it was Milton Friedman, the guy who you see here in this picture, that was considered the father of this idea, monetarism. He thought that monetary policy was much more effective at stabilizing the economy in the short run than fiscal policy. So in other words, if we want the economy to get better fast, we need monetary policy. Fiscal policy is something that works better if we have a long-term problem that needs solving. Okay, so talking about money, remember there are two different supplies of money out there. The first supply of money is what's known as the M1 supply of money. This is the highly liquid money that's in circulation. Things like cash, demand deposits, traveler's checks, debit cards, all the money that's available to be spent immediately in the economy, money that you can get right away. Now, there's another supply of money which is called the M2 supply of money. And this is the money that's less liquid. It's the less liquid money plus all of the M1 supply of money. So if we were going to imagine it as a graph, it would look something like this. The M2 supply of money is this big grayish blue circle, and it includes the smaller green circle inside. The smaller green circle is the M1 supply of money. So just think that M2 includes all of the not liquid money plus the really liquid money. However, M1 is just the liquid money. So if you don't know what I mean by not liquid money, that would mean things like savings accounts, certificates of deposit, retirement accounts, money market accounts, basically accounts that you own that have money in them, but you can't access them very easily. Basically, it's money that's not in circulation. So M1 is the highly liquid money that's in circulation that's available to be spent now. M2 is the less liquid money plus all of the M1 money. All right, so the Federal Reserve Bank, or the Fed. Okay, remember that the Fed is actually the Bank of the United States. And so they have a mandate from Congress to do a couple of different things. For one, they regulate the size of our money supply. So the Fed gets to decide how much money is available to all of us to use. The other thing that the Fed does is they regulate banks in the US. They make all the rules and regulations that banks need to follow. They also serve as the banker's bank. So when banks need banking services, like a place to deposit their money or loans, they do that with the Fed. Now, regular people like you and me cannot use those services. The Fed only serves as the bank of banks and as the bank of the US government. So unless you're the government or a bank, you can't open an account with the Fed. The last thing, and probably the most important thing that the Fed does, is that they create what's known as monetary policy, which is stabilization policy that involves increasing or decreasing the money supply. So remember that the Fed is made up of 12 regional Fed banks. Remember, we saw that map. They're all over the country. And every year, 5 of the presidents of those Fed banks get to serve on the Fed Open Market Committee. The people who serve on the Fed Open Market Committee from the regional Fed banks rotates every year. Now, there's also a group called the Board of Governors. There's 7 of them, and they're chosen by the president and confirmed by the Senate. Each of them serves a 14-year term, and their terms expire at different times. The reason why is so that no one president or Congress will have too much control over who's on the Board of Governors. Now, the head honcho of this whole operation is called the Fed Chairman. The Fed Chairman is chosen by the POTUS and also confirmed by the Senate, and they serve a 4-year term. And so altogether, the Board of Governors, 5 of those Fed bank presidents and the chairman create what's known as the Fed Open Market Committee. So they are the ones who actually make monetary policy. Now, if you remember, the current Fed chair is this lady. Her name is Janet Yellen. Although you may have heard that very recently President Trump has nominated a new Fed chair that will take her place in February, a guy named Jerome Powell. So we'll have to sit back and wait and see if the Senate confirms him. It's a good chance they will, because they're all Republicans right now, and so they want to make their president happy because he's a Republican. But you never know, right? If there's anything that this political cycle has taught us, it's expect the unexpected. Whoa, excuse me, guys. Pardon me. Okay, so monetary policy. Remember, this is what the Fed Open Market Committee does to try to stabilize the economy. So the tools that the Fed can use to stabilize the economy are, first of all, open market operations. That involves buying and selling government securities, aka bonds. There's also the discount rate. Remember, the discount rate is the interest rate that the Fed charges commercial banks when they want to borrow money from the Fed. And then last up is the reserve requirement ratio. That's the minimum percentage of demand deposits that commercial banks must hold in reserve. Meaning, like when you go put money in your checking account, it's the percentage of the money that you deposit that the bank is not allowed to lend out. They just have to keep it in their vault just in case you need that money. Okay? So remember that the Fed Open Market Committee is the one that's in charge of making monetary policy. So that includes the chairman of the Fed, plus the 7 governors and 5 of the regional Fed bank presidents. All right. Now, when it comes to monetary policy, just like fiscal policy, we have expansionary and contractionary policy. Expansionary monetary policy is what we would want to use during the contraction phase of the business cycle. Basically, if it seems like the economy is heading towards a recession and we have a lot of unemployment, expansionary monetary policy is one way to fight against that recession or to fight against unemployment. So, first off, with open market operations, the Fed is going to buy bonds. Remember that when we buy bonds, it makes the money supply bigger. And we want the money supply to be bigger so that it's easier for people and businesses to spend money. Now, when the money supply gets bigger, banks have more money to lend out and they have to compete with each other. And for that reason, it causes interest rates to go down, including the discount rate. Remember that the discount rate is the interest rate that the Fed charges banks. So when the discount rate goes down, banks will find it easier to borrow money, and therefore it'll be easier for them to lend money to consumers like you and me. Now, the last thing is the reserve requirement. And if you remember, the Fed does not like to change the reserve requirement. But if there was a severe downturn, the Fed might choose to decrease the reserve requirement. Remember, that's going to increase our deposit expansion multiplier. And therefore, every dollar that the banks have is going to create even more dollars in the economy. And of course, having more dollars in the economy will help us during a contraction. It's going to get more people to spend money. It's going to get more businesses to invest. It's going to get more businesses to create jobs. And overall, that will help reverse the trend that's happening during a recession. Okay, now, contractionary policy is the exact opposite. We would want to use contractionary policy during the expansion phase of the business cycle. The whole purpose of that is to fight against inflation. Remember, inflation is when prices are rising. So, with open market operations, we want to sell bonds. Remember that when the Fed sells bonds, it makes the money supply smaller. When the money supply is smaller, banks don't have as much money to lend, and so therefore fewer banks can loan money. When fewer banks loan money, there's less competition for loans, and that causes the interest rates to increase, including the discount rate. So banks are going to find it harder to borrow money themselves, and therefore it's going to be harder for you and me to borrow money too. Now, the last thing they would change is the reserve requirement. So remember that they would want to increase the reserve requirement because that lowers the money multiplier and puts less money out into circulation from all of the excess reserves that banks are holding. So these actions decrease the money supply, which in turn will decrease economic activity, right? Businesses are going to borrow less, they'll create fewer jobs, fewer people are going to be working, and when fewer people are working, they're going to spend less money. Altogether, that will keep inflation under control. All right, now, how can monetary policy change aggregate demand or aggregate supply? Well, hopefully you remember that monetary policy has a really strong effect on aggregate demand. If we were to implement an expansionary policy, that would cause our aggregate demand to increase. Here's why. When there's more money available to the banks have to compete with each other to loan out that money, right? All the banks want your business as a customer taking out loans from them. So the best way they can attract you to their bank over somebody else's bank is to reduce the interest rates. Now, when there's more lending and low interest rates, more borrowers are going to be attracted to getting loans. What I'm talking about here is not just regular people like you and me, but also businesses, right? So when businesses and consumers are borrowing more, they're also going to spend more. And that would cause our aggregate demand to increase because hopefully you remember that consumer spending and business investment are two important components of our aggregate demand. They're also part of our real GDP. Now, contractionary policy, that's when we would decrease our aggregate demand through monetary policy. So what happens is less money will be available to the banks. When there's less money available to the banks, they can't lend as much, and that causes interest rates to rise. when there are really high interest rates out there, borrowers are going to demand fewer loans because it's going to be hard to pay back loans with a really high interest rate. So that's going to cause consumer spending to decline, and it's also going to cause business investment to decline. Since those are both direct components of real GDP, they also cause our aggregate demand to shift to the left or cause our aggregate demand to decrease. Okay? So just remember that more money will increase our aggregate demand, but less money will decrease our aggregate demand. Oh yeah, I forgot there was a little animation there. Yay, Board of Governors. Okay, let's move on. All right, so excess reserves. Hopefully you remember that excess reserves means the extra money or the extra percentage of demand deposits that banks are not required to save. They can lend it out or they can save it. They can do whatever they want with it. Now, banks usually prefer to lend out all of their excess reserves because remember that's how banks money. I can't talk. Remember that's how banks make money. Banks make money by lending money. So most commercial banks will hold some excess reserves even though they probably don't want to. The reason why they would do that is because they want to protect against bank runs. They also want to maintain liquidity, meaning like they want to have spendable cash on hand, and they want to keep consumer confidence in the banking system relatively high. You may remember that one of the problems we had during the Great Depression was that people didn't have confidence in the banks, and that caused a lot of our banks to close down because nobody would deposit money with them. So one other reason why the banks would want to keep extra reserves is that if they ever go below their reserve requirement ratio, then they would actually need to take out a loan from another bank or from the Fed to cover their reserve requirement. That's not good for the bank because then they're incurring more debt, and that's not good for the bank because that's not making money for them. That's causing them to lose money. Okay? So holding excess reserves protects banks against bank runs, against going below their reserve requirement, and against customers just losing confidence in the banks. Now, whenever you borrow money, you know that there's this thing called an interest rate. Now, remember that the interest rate, just like real GDP or nominal GDP, depends on inflation. So if we talk about the nominal interest rate, we're saying the interest rate without adjusting for inflation, whereas the real interest rate is the interest rate adjusted for inflation. Pretty simple. So the way you figure out the real interest rate is you take the nominal interest rate and subtract the rate of inflation. So in other words, if our nominal interest rate was 7% and the rate of inflation were 2%, that means that the real interest rate is actually 5%. Hopefully that makes sense. It's pretty simple math here. Okay, future value of money. Well, when we talk about the future value of money, I don't mean like Future the rapper. Obviously, he's got a lot of money, so I don't know what his money value is. But when we talk about the future value of money in economics, what we mean is how much money will some amount of money invested today be worth in a certain number of years based on the average interest rates. Okay, so the formula for finding the future value of money is P times 1 plus R to the power of N. In this situation, P means the principal or the amount of money that you're going to invest. R is the real interest rate, and then N is the number of years that you're looking at investing for. So let's look at a scenario here. Let's say if you have $100 in your pocket today, and the interest rate is actually 2%. The real interest rate is 2%. How much money will you have in 5 years if you were to invest that $100 at 2% interest? Well, this is what we do. We would say the future value of $100 is $100 times 1.02, which is 1 plus 0.02, which is the interest rate, to the power of 5, because 5 is how many years you're thinking of investing for. So when you do the math here, and by the way, you may want to have like a graphing calculator or just a standard scientific calculator for this test, because you will see questions like this. What you'll find is that the future value of $100 invested today at 2% interest for 5 years would yield $110.40. So that means if you took your $100, put it in the bank at 5% interest and just left it there, after 5 years, or excuse me, not at 5% interest, my bad. If you took your $100, okay, you put it in the bank at 2% interest and left it there for 5 years, at the end of 5 years, your $100 will have grown to be $110.40. So remember that that's how you can let your money grow, by investing it. And so if you want to know how much money you're going to have after a certain period of time, that's why you use this equation, the future value of money. Now, the present value of money doesn't mean like how much money your parents spent on your Christmas presents, okay? Obviously, the present value of money is talking about how much money a future payment is worth in today's money given the average interest rates. So in other words, if somebody was saying they were going to give you a certain amount of money in the future, how much money would you need to have today to equal that same amount of money in that same period of time? Okay, so in this situation, the present value of money is equal to x divided by 1 plus r to the power of n. X means the amount of money that you're going to receive in however many years. R is the real interest rate, and then n, once again, is the number of years we're talking about. So remember, this is that formula you could use to figure out whether you should take the lump sum when you win the lottery or whether you should get paid out over time. In case you forgot, when you win the lottery, they give you an option. Either you can get the full jackpot, but that's going to take several years, or you can get a chunk of money right now, but it's going to be less than the full jackpot. Well, so for example, let's say if we won the lottery and we were offered $1 million over 10 years, or a lump sum of $500,000 today. Which option would benefit us more if the prevailing interest rate is 6%? Well, what we're thinking about here is like, if they gave you that $500,000, and let's assume that you didn't just go spend it. Let's say that you took the $500,000 and you put it in the bank. If the interest rate is 6%, what we want to know is, would you have more than $1 million after 10 years if you invested $500,000 at 6% interest? Or would you have less than $1 million after 10 years if you invested $500,000 at 6% interest? So when you do this the present value formula, what we need to see is, would the present value of $1 million be more or less than $500,000? If the present value of $1 million is more than $500,000, then we should take the $1 million over 10 years. But if the present value of $1 million is less than $500,000, then we should take the $500,000 right now and just invest it in the bank, and we'll have more than $1 million in 10 years. So let's do the math. So the present value of $1 million is equal to $1 million divided by 1.06, because remember that's 1 plus the interest rate, to the power of 10. And we find out that when you do $1 million divided by 1.06 to the power of 10, that gives you $558,394.77, which is actually more than what they're offering you right now. So don't take the lump sum. The lump sum is less than what you would get if you received $1 million over 10 years. What you ought to do is just say, yeah, I'm going to accept the $1 million over 10 years. They're going to give you $100,000 a year. Every time they give you that $100,000 check, put it in the bank, let it grow, and after 10 years, you'll actually end up with more than $1 million. Aha, pretty smart. Okay, now, what is measured by the interest rate? Remember that the interest rate is just the cost of borrowing money, so it reflects the lender's expectations of two things. Number one, what the lender thinks the average rate of inflation will be over the life of the loan. So money needs to keep up with inflation, because whenever money doesn't keep up with inflation, it loses purchasing power. So the person who lends you the money wants to get back as much purchasing power as they lent you in the first place. And then the other thing they want on top of that is profit. Obviously, lenders need some sort of an incentive to allow people to use their money. Right? We said one of the 12 principles of economics is that people respond to incentives. So if they can't make a profit, there would be no incentive to loan the money. So when we look at the interest rate, we're looking at what the lender thinks the inflation is going to be plus how much money they want to make off of this loan. So something you need to keep in mind here is that when interest rates are high, that increases the opportunity cost of holding on to cash. Basically, if you've got cash in your pocket and the interest rates are really high, you could be earning more money from your money by lending it or saving it in a bank account that earns interest. Now, if interest rates are really low, then that decreases the opportunity cost of holding money. Basically, you can't earn very much by lending your cash or by saving your cash, so it's probably more useful to just keep it in your pocket in case you want to buy something. All right, now, business investment, remember you need to know that investment demand model where we have the nominal interest rate on the y-axis and the quantity of business investment on the x-axis. Now the downward sloping curve here is our investment demand curve. So if nominal interest rate rises, business investment will decline and vice versa. So let's take a look at a scenario where we have a low nominal interest rate. You'll notice that on our graph, when the nominal interest rate is low, the quantity of business investment is really high. But if for some reason, like let's say for example, if the government started borrowing too much money, what we'll see is that the nominal interest rate is going to rise. And as you can see, when the nominal interest rate rises, the quantity of business investment declines. So generally, when the nominal interest rates are high, businesses invest less, but when the nominal interest rate is low, businesses invest more. You may remember that this is related to that philosophy, or not philosophy, I guess you could say, that phenomenon known as crowding out. When the government borrows more money, it causes interest rates to rise, and businesses will choose to invest less. All right, 3 functions of money, pretty simple stuff here, okay? First of all, money needs to serve as a medium of exchange. So in other words, you need to be able to buy goods and services with it. Number 2, it needs to be a unit of account. So we need to use it to quote prices and to quantify goods and services. Like you could say, I bought $10 million worth of grain from Russia or something like that, okay? And the last thing is the store of value, meaning that you can put money away and use it to buy stuff in the future, or you can use it to buy stuff right now. It gives you the versatility of making that choice. So money should always be a medium of exchange, a unit of account, and a store of value. All right, last thing up is important terms. We've been doing this for 30 minutes now, so let's just go ahead and get it, okay? First term, Fed funds rate. Don't be confused by this. Remember that the Fed funds rate is actually the interest rate that banks charge each other when they borrow money. Now, the discount rate is the interest rate that the Fed charges banks. I know that that's really confusing, guys, but just study till this is in your brain. I know that it's easy to get them mixed up, but if you study and practice, you won't mess it up. Now, open market operations, that involves buying or selling government securities, aka bonds. Now, treasury securities is just a fancy term for government debt or bonds, right? All these different terms for bonds. Now, demand deposits means checking accounts, okay? Real simple. You can get your money on demand. Liquidity means the ease with which an asset can be spent. So how easily can you turn one of your assets into cash? If it's really easy to turn an asset into cash, then it's liquid. But if it's difficult to turn an asset into cash, it's what we'd call non-liquid or less liquid. So cash is the most liquid kind of asset, whereas other kinds of assets are less liquid, like for example, a house. Obviously houses are valuable, but it takes a long time to turn a house into spendable cash. Now, an asset is something of value that you own or something of value that is owed to you, whereas a liability is something of value that you owe to somebody else. And last of all, a capital inflow or capital inflows. That means money coming into the U.S. from abroad. So when foreigners put their money into the U.S., it's called a capital inflow. Whew. Okay, that was a really long test review, guys. Thank you so much for sticking with me all the way through it. Hopefully all this information will help you do better on the test. But remember, watching this video one time is not enough. You really need to study. Go over this again and again until it's all up here in your brain. And then when you come in and take the test, it's going to be so super easy. It'll be no sweat, right? So study your notes. Good luck, guys. I'll see you on the day of the test.